Yeah. Today we have Mr. Thomas Michael from Crystal AI, who will be touching on the topic of actually, interestingly, the algorithmic investing. I think this is something that's popular and it's a trend, right now. And so our speaker Thomas here, he has got over 25 years of experience in the banking and finance industry. Started off with Bank Austria and joining JP Morgan Singapore, and now leading the advisory team at Crystal AI. Yeah. So I think without further ado, I'll hand over the time to Thomas. He will be bringing us through the session, and there will be time for Q&A afterwards as well. So please feel free to ask the questions in the Q&A chat function, in the Q&A function at the bottom of the screen, of your screen. Or if you like to, okay, you are also invited to unmute yourself and interact with our speaker and pose your questions to him live. Yeah. So without further ado, I think Thomas, over to you. Thank you.
Thank you, Sokian. Thank you for the introduction. Hi everybody, and good evening. Thanks very much for joining us. Thanks very much for joining us. My name, as Sokian said, is Thomas Michael, and I'm working for Crystal AI. Crystal is a digital wealth manager, and we based in Singapore. We also have offices in Hong Kong and in India, and our platform is offering, catering to various needs for investors, whether it is for retail investors who want to use a robo-advisory offering, or whether it is for accredited investors. But anyway, without further ado, I think that the key reason why everybody of you has joined us here today is that you want to know or want to have an answer to the question, what should I do with $10,000? And that's kind of like one of the main questions, and there's never a better time than now to ask that question, given the environment in which we are in. So I think, first of all, let's look at the market environment that we are in and what has happened so far in 2020. And this is kind of like boiling down to us being in probably the most challenging times for a lot of people, from a personal situation due to the COVID crisis, but also from an investment perspective. And as Sokian said in the introduction, I've been around for quite some time. So I started my career after graduating in the mid-90s in Austria, working for an Austrian investment bank, trading fixed income in Europe in 94. So I've seen a number of events, whether it was LTCM collapse in 95 or the Russian default. I've been in Asia in 98, just after the Asia crisis happened. In 07, 08, during the global financial crisis, I was working for JP Morgan, managing the counterparty risk credit portfolio. And that was at the height of the financial crisis. But what has happened and transpired between February and right now, it has been the year of most ever. Yeah, it has been the sharpest drop in the market ever in the shortest period of time, the sharpest recovery. We have seen the quickest slowdown in growth, and sharpest rise in unemployment. These are all very difficult environments, because most models are not necessarily trained for these kind of environments, and it requires a lot of careful consideration from a lot of investors what to do with their money in these days. Also, I think it's shown to some extent in terms of the dispersion of analyst expectations that we have seen throughout the year in the market. And there's still very broad discrepancy depending on which research you're reading and which analyst is coming out with their expectations. Especially the time around April, May was very, I would say, you had a both ends of the spectrum were occupied, but there was relatively little in the middle, with a number of people expecting that markets will rise to new all-time highs due to the stimulus. The other half expecting that we will see new lows, given that the economy is still not recovering and it is going to be a long and pronounced recession. But what we have seen definitely so far is that the resurgence in the tech sector has been enormous. And as the Microsoft CEO has said it in the latest earnings presentation, due to COVID, we have seen a technological advancement in the last 3 months, which we expected to see probably over the next 5 to 10 years. Whether it is Yola right now on the product, whether it is Zoom, which just yesterday announced earnings, which are up 300% on a year-on-year basis, or other efficiency cloud-related companies, also in the cybersecurity space, we have seen an enormous rally. And of course, also biotech on the back of hopes for a COVID vaccine or treatment. Now, this brings us sort of like to the challenges that we have of investment today. And I think the first challenge is, or the first action that every investor needs to take when it comes to investing is you have to have a plan. Yeah, and a plan, with a plan, action and execution can be much easier, and it prevents the risk of making false decisions for the wrong motives. And the plan is, I think, first of all, the important thing is to have an investment objective. Yeah. So depending on where you are in your life, in your career, and how you're starting off with, and what you are saving for, and why are you investing, there needs to be an investment objective. So a lot of our clients, they are investing with the objective of retirement. They want to retire when they are 50. A lot of them, some of the middle-aged group in their 30s who have family, they are investing for the children's education. Or some investors are also there, they like the excitement of it. Yeah, that is also kind of like an investment objective to some extent. Yeah? But this investment objective is kind of like defining then your risk tolerance. So the next step is then, based on your investment objective, what is going to be your risk tolerance? That has to be part of the plan as to how much are you willing to lose in terms of what is the drawdown risk. If you buy a stock today and then next month there's a market correction, the market drops 20%, does that mean that it's of course nobody wants to experience a loss, but what is the reaction to that? Yeah, does it provide a significant dent in the personal wealth or not? And that kind of like defines what is the risk tolerance that everybody can have on their portfolio. And lastly, then the next step in the investment plan is also the deployment. So deployment is kind of like what I have here in this slide is often we are facing the problem of like the buyer's regret or buyer's remorse. It's like, should I buy or hold or sell? And I'm also experiencing it, and every professional is experiencing it. Of course, now that we are sitting here on the 1st of September and we're looking back on what the market has done, we are saying, I wish I would have bought that in April. Some of you have, and good on you, and big kudos to everybody who did have the nerve. But again, it was a very difficult decision for a lot of people to take, given confusing expert market views that were around. There's a lot of noise that is always in the system at any point in time. Now, one solution for deployment then can therefore be to use an algorithm to keep the personal emotion and the gut feeling out of the equation. And we have developed at Crystalline an algorithm that helps us with investment decisions to a certain extent, especially across identifying the right instruments and the right asset allocation. And it is a combination of various inputs. So first and foremost is there's a small degree of a human component in it as well, in terms of the development of the algorithm, of course. Yeah, but then looking at the risk profile and looking at the risk-adjusted returns of the instruments that are forming part of the investable universe, that gives us then the desired output. So our inputs into our algorithm is market data, of course. It is the investor profile, the risk profile, and the objectives. And then we're also using an input from our investment committee, which is 5 people with a tremendous amount of experience in the market, various backgrounds from fixed income traders, hedge fund managers, etc. That is looking into certain factors that we are using to decide whether these factors need to be overweight or not. Yeah. Then the genetic algorithm is using all these parameters to come up with an unbiased asset allocation recommendation. And that is sort of the key as well in terms of the investment objective, and in terms of the deployment, is what is going to be the asset allocation. We have also developed some of our products which are mirroring the outputs of the investment algorithm. So that's one of the examples that we have here. But what I wanted to show is actually our using an algorithm versus a static benchmark, because there is also a rebalancing factor as well in there, is over time it produces superior returns. The same is when you are making the decision, should I invest 10,000 today? Second question is also, at all points in time, it is important that you need to check as an investor, has anything changed in my circumstances? Has my target changed? Has my investment objective changed, or has my risk appetite changed? And that will then lead also to certain adjustments that are necessary for your portfolio. So coming to the question, should we invest in this environment? I think personally, I'm of the opinion that there's no environment that says don't invest. Yeah, there's always a good reason to start investing, and it's never too late or too early for that matter. It's more about the challenges and the risk management that is important here. Yeah? So there again, various views that are existing in the market, whether it is from the talking heads on Bloomberg and CNBC that are coming, or from various bank analysts, etc. But many have been recommending increasing gold allocation. There's also a view that investment grade bond deals, or bond deals in general, near zero, are challenging for the standard portfolio allocation, portfolio build. And then you have, of course, the equity investment and the strong run-up that we have seen already in equities that is causing a lot of people to be hesitant in this market. Then throw into the mix the heightened market uncertainty. So I think the key event that is ahead of us for the until the end of the year is the US presidential elections. So while we have at the moment some of the opinion polls are suggesting that Biden is having a lead, or a comfortable lead, but various other models are suggesting that it's actually not such a clear-cut race, and Trump might be ahead, given various political difficulties that the Democrats have in unifying their supporter base. So it cannot be ruled out a surprise in either direction. Yeah, and the market is at the moment not discounting that to a large degree, in my opinion. But that's definitely a period where we will see increased volatility in either direction. Yeah. Then Brexit, while it did seem like it's a done deal, but with COVID, there is still a couple of unsolved or unresolved issues that may happen, that may cause further uncertainty down the line. The risk of second wave in COVID-19, renewed lockdowns. It's happening right now actually in Europe, where some countries are starting to close borders again. Yesterday, for example, Hungary has shut their borders again and prevent anyone from traveling into the country. So this is going to be an ongoing issue that will stay with us for another couple of months and may have impact on the risk sentiment. Last but not least, and I think this is kind of like in the bigger macro theme, the most interesting and relevant risk scenario at the moment is the US-China relations. And so while it started off as a trade tension, but it is also increasingly a political confrontation, whether it is the saga around TikTok in the US or the maneuvers in the South China Sea, etc. So there is, I think this topic will also remain on the forefront for quite some time and has the potential to cause market repricing at any point in time, depending on what the news flow is. So in such an environment, the important thing, and this is again brings me back to the earlier comment, it's regardless of the economic climate, the risk management is important, portfolio diversification is important. So one goes hand in hand with the other. Diversification is a subset of risk management, of your risk management strategy. But there are also other ways of managing your risk across different ways, how to deploy your capital. So one of my favorite things, and this is especially I think important for a young audience or for young investors and people who are starting off, is I see a regular investment plan or systematic investment plan as a actual effective risk management tool. What that means is, I think most of you will have heard of dollar cost averaging, but it is something that ultimately introduces you a certain protection in your portfolio, because you're buying at different points in time into the market, rather than having a lump sum investment and running the risk of picking the wrong timing and investing right at the peak of the market, and then have to watch that it goes down. And what we have used is that we, in general, in times of high uncertainty, it is always best to space out your deployment of capital over a certain time horizon. So right now, as I said earlier on, we have got presidential elections. So I think SIP that goes beyond the November date and well into January is actually a good approach, and is a good risk management tool, because no matter what the outcome is after the election day, if it's a close call, and we have seen this before, there might be a lot of political noise about the recount, and that could mean that the US political scene might be in limbo for a couple of weeks, which could well go into January, by the time where the new president is going to be sworn in into the White House. So that is one effective way of managing risk and investing. That can help you as well to relieve a little bit of the fear of, like, do I have the right time? Yeah, so I think that's kind of like the key question for everybody. Is it the right time to invest now? Well, various methods to tackle that. One of them, systematic investment plan. So we've put out here a couple of scenarios on different market movements. So one is market correction, then back to where it has been. On a lump sum investment, you're still making a decent profit, but if you would have gone by a monthly investment plan, for example, your return would have been much higher because you would have been buying all the way. You started off here and buy until April and then run into the recovery. So that's kind of like your ultimate return is going to be better for that. Second scenario is, even if the market keeps dropping and doesn't recover, still on a systematic investment plan, your losses are less than through lump sum investments because you're buying again in the way down. Yeah? And here, this is a recovery back to the previous level. That shows similar behavior. So all in all, I think in what comes up for this one is that planned investment in tranches is always better than a lump sum investment. That's kind of like the overarching message for that. So the next part is what we talked about diversification. Here you have various options available. Yeah, so there is the ability to invest in portfolios that are managed by algorithms. Robo-advisors are plenty and abound. I can only speak to the products that we have, but as I mentioned, we have these what we call the autopilots, which is like a mini fund using ETFs, and that is rebalanced in regular intervals. So at least every 3 months, or whenever there are substantial changes in the market parameters, we're looking to rebalance this product. And it gives you exposure, or it gives every investor exposure to multiple asset classes. The other one is thematic baskets. So this can be either thematic baskets for equities, whether it is you're looking at cloud ETFs. There is an abundance of different variations in the market that we have in the technology space. Literally for almost any technology, there is a ETF available these days with varying successes, but that allows investors to have a more granular structure in the portfolio and really focus on thematic baskets. One thing I would say as well is be mindful and always maintain a look through as to what is in the ETF. Yeah? There is always a chance that you might end up with a concentration of specific names in your portfolio, because some companies, they are also overarching into different areas. Like if you take, for example, Amazon. Amazon is in an e-commerce ETF. Amazon is in a cloud ETF. And if you would focus on these two asset classes, your allocation would actually be larger than that. So it does make sense if you're inclined so, and if you want to spend the time and the research to look also through into what are the top holdings, and is there a lot of overlap, and does it lead to a very concentrated position. Asset allocation, that is probably the most challenging and most important question as well. And of course the passive investment. Let me get back to the asset allocation. Why I'm saying that is because I think asset allocation goes directly back to your investment objective as well. Like, what is your time horizon? What are you looking for investments? I give you two scenarios of some client conversations that I had over the years. One was a client who came to us and saying investments for real estate property purchase, but it's not going to happen now. It's something that's most likely going to happen in a year's time. Not sure, maybe 1 year, maybe 18 months. In such an instance, the asset allocation is going to be geared more towards a defensive portfolio and with a relatively high fixed income allocation. The reason why is because 1 year or 18 months is actually a relatively short period of time. And we do have there's a very high statistical probability of market pullbacks. And the worst that can happen is that the client is ready to, investor is ready to buy the property, and then is checking the portfolio, and we just had a 20% correction in the markets, and there's not enough money there to buy that property. So in order to avoid that, asset allocation, the shorter the time horizon to your drawdown, the more defensive your portfolio should be. Somebody who starts out in their mid to late 20s with the objective of retirement savings in 20 years time, 30 years time, there you can be, the asset allocation can be much more aggressive and can be much more geared towards equity, given that while you do have all these market swings and sharp corrections that occur every now and then, but if you look back the last 50 years or last 30 years, markets do have also the tendency to come back from these corrections as a natural function of the economic growth that is happening. So that's kind of like even people who started off investing in 1929, if they waited until the 50s or 20 years later, they were back to where they have been. Yeah, so there is kind of like this element of longer term focus allows you to take more risk, be more aggressive with the asset allocation as well. Okay, so I think this is kind of like the broad outline, and I wanted to keep the presentation or the talking parts of it fairly short, and really leave it open for Q&A for anybody. I think we can open up the lines as well for anybody who wants to ask a question live, or you can use the Q&A tool that we can go through. That's really up to us. So yeah, handing over to you, Sophia.
Yeah, thank you, Thomas. So we have one question in the Q&A. You can take a look. Yeah, the question asks,
So what are the triggers for reoptimization of the portfolio? I assume that this is relating to the algorithm, right? So
yes,
we're looking to update the market data on a monthly basis at a minimum. This year, when we had this sharp market moves in March and April, we actually updated the parameters of the algorithm every 2 weeks to cater for this change in the market environment. So the triggers are, I'm looking at the inputs into the model. The inputs are the volatilities of the instruments, of the ETFs, of the indices, macro factors, as well as price data. And if there's a sharp move in these factors, then that will trigger a reoptimization of the portfolio. The algorithm is also looking at the risk-adjusted return. So it's looking to optimize for risk-adjusted returns. So when we load new market data, then there's new information available, then which is then basically optimizing that portfolio. Yeah. So answer to that is 2 triggers. One is time dependent. The other one is market move price dependent.
Right. We have more questions coming in the Q&A. But before we go to the Q&A, there's one question in the chat as well from Asa. Regarding the comparison graph you showed just now, what did you use as the benchmark?
Yeah. Oh, the comparison, the benchmark was a portfolio of 60% S&P and 40% of the Sorry, get back to that slide. Yeah, it was 60% S&P and 40% of the US fixed income. That's the BLV, the all bonds ETF. So it's a government plus corporate ETF. Sorry, I'm just trying to reshare my screen. There you go. Okay. So in this case, this was just SPY, the State Street S&P 500 ETF, plus the HEG is the ticker of the other ETF, aggregate bond fund. So that's the classic 60-40 portfolio that we have. Then there's one other question that I saw is about withholding tax. That's a great question. So we have. I receive this question quite often, and this is unfortunately something that is very hard to circumvent. Now, there is a 30% withholding tax for all the US incorporated funds and any dividend payments that we have. Now, one way to optimize that is there are so-called UCITS, so undertaking and collective investment trust schemes, which are island-based, and due to the double taxation treaty between Ireland and the US, this withholding tax is reduced to 15%. But I have there's different schools of thought around that. So UCITS is one way to save this withholding tax and minimize it a little bit. But even here, I think what investors should also look for is it an income generating ETF or is it a capital gains or growth ETF? Because the 30% withholding tax is due on dividend payments. And in the current environment where we have got this extremely low rates environment, so most of the bonds ETFs, if you're investing in, for example, a US government bond ETF, depending on the maturity, but your yield is somewhere between 0 to 1.3%. Yeah? Or if you look at the S&P 500 ETF, your dividend yield, while the expense ratio is also low, but the dividend yield is now close to 1.7% roughly. Yeah? Often these UCITS, they command a much higher management fee and have a higher total expense ratio. And therefore, there is kind of like a break-even rate as to where does it make sense. I personally try not to be too cute around saving the withholding tax, especially in a low rate environment. If we are entering an environment where yields are back to 5% and dividends are also in that area, then this 30% withholding tax really becomes a very important cost factor. And then it's definitely a consideration. We are exploring a few ways with our prime brokers to get back this tax. And this is, I think, what other advisors are also offering. But that is also associated with a cost. And that only makes sense if you have more than $5,000 of dividend income to claim back this tax. So there's a couple of service providers who are doing that. Okay, so, but this is definitely, the withholding tax is something that is borne by investors. Yeah, so it is automatically deducted from your dividend payment at source. Yeah, so that's why it's withheld at source and withholding tax.
And we have a very interesting question next really posed to Crystal, right? How is Crystal positioned differently from the other robo-advisors? Are you able to opine which is your strongest competitor? And if so, what's the main strategy difference between Crystal and this competitor?
That's a great question. Fantastic. I love that. Thanks very much for this. I would say we don't have a competitor per se, because Crystal is unique in its sense that we are catering for both ends of the spectrum. I think we have our digital solution, which is the advisory algorithm. It's a digital portfolio that is very good for investors to start off. That's very similar in the look and feel to a robo-advisor, but our biggest advantage here is the ability to pick and choose for investors. So anybody who comes on our webpage and signs up, you have the ability to choose from more than 200 ETFs. So it's not only constrained to 8 portfolios or 10 portfolios that some offer for different needs, but it's really something for the investors which are more hands-on, a solution to give her or him the ability to select their own investments. And at the same time, we're also providing the comfort of fully managed products and thematic baskets, thematic investments within our digital offering. So it's like a little bit like a mini hedge fund, I would say, or mini funds. I mentioned the autopilots, for example, which are following our algorithm, or we have a couple of other thematic baskets. So please take a look at our offering, and I hope that the differentiation here is very clear. But the other part is that we want to have our clients also accompany them through the journey. So we are catering a lot for accredited investors and the mass affluent investors, and we have a much broader offering for anybody who qualifies under the Singapore rules as an accredited investor, where we are able to, just recently we started, for example, direct private equity investments. We have access to hedge funds. We have our own managed funds, and that's a very different level. That is almost, I would say, Crystal AI in that sense is a digital private bank, yeah, which is something that the other robo-advisors do not have.
Right. Thank you. Thanks for sharing that. And so, would I be correct to say that each robo investing company has their own algorithm, for their investment strategies?
Yeah. So there is no. I would say it's a little bit like a fingerprint. There's no identical algo in this universe. Yeah. And we have last year we participated in a competition which was in Hong Kong from a platform where we were competing against 3 other robo-advisors, which we won in the end. I have to say, I'm proud to say that. But it's in terms of the absolute returns, yeah. But everybody is using different approach to how they train the algorithm, how they train it, how often do they rebalance, etc. What products are going into the algorithm? Yeah. So I think that is the main part of this. Yeah.
Right. Thank you. We have a follow-up question to the very first question just now. It's so far, when were the reoptimizations, and would the consumer be informed of the reoptimizations?
Mm-hmm. Yes, so we do send out notifications to our clients through the app if and when they happen. I have to admit that autopilots are a relatively new product that we only started this year. So there has been one update in June, and there's one coming now actually in the coming week. And there have been various updates. We have another ETF on the retail platform. Another basket which is called the Catalyst, that has a much longer history. That has been live since the start of Crystalline in 2018, and there have been various rebalancings over time. Usually, what happens is that within a day, sometimes even in the same week, we are updating our fact sheets as well when these rebalancings are happening.
Right.
The timing is dependent on when we upload our market data.
Okay, great. Yeah. And we have some more questions here. Another one on, would you be able to share some of the strategies or options which are generating constant and regular income?
So I'm taking this in a more generic way of like overall market products, because I think this is one of the big challenges in this environment, in this low yield environment. At the moment, really the global rates environment is near zero. There's hardly any yields, or let's put it that way, the risk reward ratio for taking, for example, high yield exposure is very compressed. Like some of the US high yield sectors, which are where the Fed is distorting the market due to their buying of high yield bonds. Yields have gone down to 3%, 3.5%, which is very tough if you still deem this to be a high yield instrument, and that makes it very difficult to have that income in a portfolio. Currently, I would say the good options that we have still is some of it's more into this resurgence of economic activity. In some sectors, the dividend yields are more attractive than the fixed income yields. In the REIT sector, we are still on average, I think market average is at about 4% at the moment, can get up to about 5-ish in that area as well. So REITs are generating income through their regular dividend payments. However, even there, you do have the risk of, I think, one part that is clear for all of us is that even the real estate space has changed to a certain extent, especially in the commercial real estate. You just need to go to any of the malls in Singapore and see how many shops have closed in the last couple of months here. So that is also not really has got its risk associated to that. Yeah. The other part is also in high dividends, and that kind of like brings me a little bit to this whole value theme, value stocks versus growth stocks. So in the value space, or what is widely deemed to be a value, there's still significant amount of dividend yield there, definitely more than what you have in the broader S&P. So I mentioned earlier on, S&P is at about 1.7% market yield. If we take Russell value index, for example, there the dividend yield is more in the 3.5 area. Yeah. So that's, for me personally, call me old-fashioned, but at the moment where valuations are in income, I'm looking more for these kind of dividend plays rather than fixed income. Yeah.
Okay. Yeah, and before we look at the Q&A, there's one question posed in the chat. It's quite pretty long. I retype it there in the chat for everyone to see the question. Yeah.
Yep.
Is it possible to share the resiliency of the system to navigate the recent turns in the market?
The resiliency of the system in terms of, I think, is best answered by performance, and brings me back a little bit to the performance that I showed early on for the autopilot, and it also helps me a little bit to answer another question that I see in the queue, which is about whether the algorithm overweights any sector in different periods, or whether it's sector neutral. So it does actually, our algorithm does take into account sector ETFs, and it does take into consideration that as well. And to give you one example, on the rebalancings that we had this year, for example, for the catalyst that I mentioned, or for the autopilot, the one of the choices that came up in algo results that we had either seen at the client portfolio level, but also when we use it for the products, is suddenly in January, February, we started the addition of healthcare ETF into one of our products. Or when we rebalanced in April, suddenly our algorithm was overweighting technology sector, which was very good because in that in this recovery, in this rebound since April, that has carried a lot of the performance and picked up the slack that you would have on a broader market, basically. Yeah. So yeah, we do have a history of these rebalancings, and we're looking to have it a bit more, I would say, proactive in terms of the client communication, because I realize it's very important for people to see and to read what is happening there. But in my opinion, any algorithm that you have, any investment algorithm, is always also sector. Yeah. So I personally, when I look at the market, I always take a top-down view. I look at the broad economic environment and then try to find the sectors that are more or less resilient in this market environment. And that gives me a very good sense of where can we find, or where's the right place to look for opportunities.
Right, thank you. And
do we have anybody who wants to ask a question over the line, who is not able to type? I don't know, we need to...
we have 2 questions more in the queue. Yeah. Yeah, Thomas, would you like to share about what are the quantitative benefits that we are looking at for a robust strategy into US S&P versus buying the S&P ETF directly?
So that's a very good question. I would say the quantitative benefits. I'm a little bit thrown off of the S&P. So I would say our quantitative strategy is not only focused on S&P. So it's looking again into different sectors, overweighting sectors based on their relative performance in the index, and therefore, in the long run, you would say that it does outperform the broader index. It's also, most of our portfolios, they are not necessarily 100% equity portfolios. So you do have a little bit more of this risk management by a shift between the asset allocation, between fixed income, equity, also commodity exposure. It's also a very important part of the asset allocation that is taking into account in a quantitative approach. So I call it the all-weather philosophy, which is, everybody is probably familiar with Ray Dalio and Bridgewater, which have coined that term. But it is sort of like trying to build a portfolio that is resilient in all different, across a broad spectrum of different outcomes, by looking for an optimal mix between fixed income, equity, and commodity. And commodity here is an offset against inflation risk. And there I see the benefit, and the quantitative benefit, that with this approach, you're able to reduce your drawdowns in the portfolio compared to the S&P. So when I look at these portfolios, these balanced portfolios, or all-weather portfolio, in March, when we were at the height of the crisis, we saw drawdowns in the region of 10–11%. Yeah, whereas the broad just S&P peak to trough was 35%. I think it was the number, around 30%. So that is kind of like the main difference here in terms of the benefit that I see for that approach. It smoothens out your return over time.
Okay. Right.
And then to the last question, how does the algo consider trends like Robinhood traders who invest in swing and penny stocks? This is currently not. It is currently not built into the algorithm. So our algo doesn't invest in penny stocks, and it's not piling into that segments. What we do see is it's not chasing these trends from the way how it is built and perceived, but it is starting to overweight and to pull, of course, that also into consideration. But it's not something that is inherently built into that trend.
Great. Thank you so much for sharing. Would there be any more questions from the audience for Thomas? Please feel free to unmute yourself and ask the question live as well if you like.
Yeah. So I hope this was helpful. If there's any questions that come to your mind post that, then please reach out to us. Support@crystal.ai. You can send us your questions, and I would be really happy to hear from you. And other than that, I do hope that it was to some extent useful. As I said, it's very exciting times that we are in. There's never a wrong time to invest, and always be mindful of having your investment objectives aligned with your risk appetite, and that will hopefully lead to superior long-term outcomes for you. So thanks very much for that.
Yes. Thank you very much, Thomas. And with this, we come to the end of the webinar. Thank you also for those who have joined us this evening. We hope you have a lovely evening ahead. Thank you.
Thank you very much. Bye-bye.